Time now for a look at the day's top business news. Brian Quinn joins us on set for that. Brian, we're going to start with a closer look at the trade relationship between the United States and Canada, as Donald Trump's new tariffs are set to come into effect on Tuesday, I believe.
Indeed. So Canada is, in fact, the U.S.'s #2 trade partner, second only to Mexico, which is, of course, also targeted by Trump's 25% tariffs. In the first 9 months of last year, just under $700 billion worth of goods and services crossed the U.S. northern border. That is $3.6 billion in commerce every single day. Canada is actually the #1 destination for U.S. exports, $350 billion worth for the first 3 quarters. Trump has railed against America's trade deficit with its northern neighbor, claiming that the U.S. subsidizes Canada to the tune of $100 to $200 billion per year. The reality is, in fact, far different. America does have a trade deficit in goods with Canada, but it amounted to only $45 billion last year, the second lowest among all U.S. trading partners. Canadian government data shows that the trade deficit actually disappears entirely when exports of cheaper Canadian oil are factored out. Without oil, the U.S. actually has a $45 billion trade surplus with Canada, and that is likely the reason that Trump put just 10% tariffs on Canadian oil as opposed to the 25% he slapped on the rest of the country's goods. As analysts say, U.S. refineries will struggle to replace Canadian supply. Take a listen here.
If you don't take in Mexican and Canadian oil, it's a very heavy grade they both produce, and the refineries in Houston are engineered to that grade. And you don't quickly change the grade of oil that goes in on one end and then comes out as gasoline and aviation fuel on the other end.
So how then is this trade war likely to affect the consumers?
Well, they're likely to see higher prices across the board for imported goods, particularly on produce from Mexico. One of the biggest sectors that is likely to be affected as well is automobiles. The NAFTA free trade deal and its replacement under Trump's first term, the USMCA, provided for largely tariff-free cross-border car production. Auto parts actually cross the Canadian or Mexican border an average of 7 to 8 times before a vehicle is fully assembled and sold in the U.S. Canada supplies around 9% of America's automobile production. Mexico is about 20% due to the tight integration of automotive supply chains on the continent. Some estimates predict U.S. car prices could spike by around $3,000. We do have some ready examples from Trump's previous trade battles. In 2018, he slapped 50% tariffs on imported washing machines. Consumer prices for them in the U.S. went up by around 12%. Americans ended up paying around $1.5 billion extra per year for them. Canadians themselves predicting severe disruptions in the North American automobile market.
But I also think that it's going to hurt the U.S. economy because here in Ontario, we make a lot of auto parts. We sell to the U.S. They make cars. Now the cars are going to be more expensive. So I'm not sure what's behind it. But all I know is I fear we have 4 more years of chaos.
What kind of reactions are we seeing from the markets to this latest trade war, if you like?
The Asian index has perhaps unsurprisingly lost considerable ground on Monday as investors react to Trump's 10% additional tariffs on China. Mainland indexes in China are still on holiday for the Lunar New Year, but Hong Kong is trading. The Hang Seng there down around 0.5%. The Nikkei in Tokyo and the Kospi in Seoul each down by more than 2.5%. Cryptocurrencies markets are taking a big hit as investors flee high-risk assets. Bitcoin headed south towards 90,000, with Ether crashing by nearly 15%, as we see there. Crude oil prices, meanwhile, quickly spiked over the potential disruption of Canadian shipments to the U.S. American benchmark WTI up by nearly 2%. Many analysts, though, are predicting that the spike will be temporary and that crude prices will likely come down significantly in the long term as a new trade war dents global demand.
Okay, so it was Mexico, Canada and China already been given the date that tariffs would come into play this week, but the EU looks like it could be next in the firing line.
Indeed. Brussels had until now indicated that it had hoped to avoid a trade conflict with Trump through negotiation, but with that looking increasingly unlikely, the bloc is bracing for a trade war with its most important trading partner. Camille Knight reports.
Donald Trump has made it clear his threat of tariffs wasn't a bluff. And now that they're official for China, Mexico and Canada, the EU could be next in line.
We are treated so badly. They don't take our cars. They don't take our farm products, essentially. They don't take almost anything. And we have a tremendous deficit with the European Union, so we'll be doing something very substantial with the European Union. We're going to bring the level up to where it should be. And
the EU does export more than it imports from the US, though a trade deficit isn't inherently detrimental to a country's economy. In 2023, the bloc exported more than $500 billion worth of goods to the US, and it's been drawing up contingency plans for a trade war for months now, putting together a list of products it could hit with duties of 50% or more if negotiations were to fail. The EU now says it's ready to respond firmly, and leaders of the bloc are presenting a united front.
As far as the European Union is concerned, I can say that it is a strong economic area. It has its own scope for action, and building on this strength, we can clearly say that we will try to continue pushing for economic relations with the perspective of cooperation and collaboration.
Economists have been warning that tariffs would harm US consumers. On Sunday, Trump said Americans may feel economic pain from his tariff policies, but that it would be worth the price.
So buckle up, Eve. It's going to be a long 4 years, I think.
Okay, Brian, thanks a lot for that business update time.